Hello viewers, welcome to my channel. I'm Hasham. Previous videos I have explained you the format of question paper for income tax, in which I have explained the section A consists of 20 marks, 4 marks each, 5 questions. Section B, 5 questions are there, each question carries 12 marks. In this I have explained that one will be theory and one will be problem. You can attempt any one, but always give preference to problems because you may get maximum marks in problems. But if you are unable to do the problem, you must be in a position to write the theory. So in this video, I am going to explain what are the 12 marks theory question in section B. For each unit, what are the important questions, very important questions I am going to explain in this video. So watch the video carefully till the end. Then definitely you will get the complete command on attempting the theory question for 12 marks. First of all, take the screenshot of the points of the questions which I have written on the board, then I'll explain all the questions in detail. The unit number 1. In unit number 1, totally 7 questions I have selected, and these I have analyzed the previous year question papers and what type of theory questions they may ask I have taken account. So first question, define tax and write the differences between direct tax and indirect taxes. Very frequently they will ask. First of all, the definition and meaning of the tax. Tax is a contribution made by the people to the government for common expenditure. Adam Smith has given the definition of the tax from different angles. From different angles in the sense, from the public point of view, tax is a coerced payment. That means it is a forceful payment on the people to pay the tax to the government. From the government's point of view, tax is a revenue received from the public or collected from the public for the common expenditure. From the administrative point of view, tax means it is the form of collection from the people according to the rules and provisions given by the Income Tax Act. Like this, from different angles, the tax is nothing but the amount paid by the people to the government for the common expenditure. Now, taxes are divided into direct taxes and indirect taxes. Direct tax is a tax which is imposed on a particular person. That person should pay the tax without shifting the burden to any other person. Example of direct tax is income tax. When income tax is imposed on a person, that person alone has to bear the burden. That means the payer and the person who born will be same. Like income tax is imposed on you, you alone have to bear the burden. Like professional tax, income tax, examples of direct taxes. Now, indirect tax is that tax on which paid by one person but borne by another person. Normally, indirect taxes will be on goods and services. So, when we purchase the goods or take the services, we have to pay the tax. That means ultimate burden will be on the people, but the person who pay the tax will be different person. The seller will pay the tax, but ultimate burden will be on the people. That is indirect tax. Second question, explain in detail the objectives of tax. The objectives of tax may be traditional objective, modern objective. The traditional objective is to remove the disparity between the rich and the poor. The government will collect the taxes from the rich people and spend the money on the poor people so that the gap between rich and poor will be reduced. In the same way, the government needs expenditure for running the country, like law and order, defense and infrastructural facilities, health, education. All these things are the responsibility of the government. The government needs funds, so tax is collected. But the modern view of the tax is, the tax is collected for the economic development of the country. The government has number of objectives like remove the regional imbalances, increase the employment opportunities, and make the direction for the economic development, restrict the import and promote the export. All these are the modern objectives of taxation. Third, explain different forms of taxes. Taxes are of many types, like duty. The duties are excise duty or customs duty. This is the tax on production of the goods. When the goods are produced, excise duty will be imposed. Similarly, when the goods are imported or exported, the customs duty will be applied. Apart from duty, cess. When the government provides a particular benefit to the people, they will collect the tax in the form of cess. Example, health and education cess. Similarly, water cess, like this. Next comes the taxes like income tax and excise duty, income tax, and apart from that we can take the example of entry tax, octroi, and another example is terminal tax, and one more example is you can take the example of toll tax. That means on vehicular traffic, toll tax will be applied. So different types of taxes are there. What is the general rule of taxation and the exceptions to the general rule? The general rule is when the income is earned during the previous year, it is taxable in the assessment year. That is the normal rule. Whatever we earn the income in current year, we have to pay the tax in the next year. So income earned during previous year is taxable in assessment year. That is the general rule. But there are some exceptions where the tax will be imposed on the same year when it is earned. That means in the previous year itself they have to pay the tax. For example, if a person is leaving the country for a job with the intention not to return back in the assessment year, so before leaving the country he has to pay the tax. Whatever he has earned during the previous year, he has to pay the tax during the previous year. Similarly, non-shipping companies who does not have any office in India, shipping companies will earn the income when they carry the goods from one country to another country. So before leaving the port, they have to pay the tax. Similarly, for discontinued business, if a business is discontinued during the previous year, the same year they have to pay the tax. Similarly, if a person is found to avoid the tax, in that case the Income Tax Act will apply the tax in the same year, previous year. These are some of the exceptions where the tax will be applied in the previous year itself, not in the assessment year. Next comes explain the provisions of Income Tax Act regarding determination of residential status. Income tax is not imposed on the citizenship of the person. Citizenship may be an Indian person or a foreigner, does not make any difference because citizenship is defined by the Constitution. But residential status provisions are given by the Income Tax Act. How many days the person stays on the land of India? So we have three categories of individuals: ordinary resident, not ordinary resident, and non-resident. So in the previous year, we have to find out whether the person is ordinary resident or not ordinary resident or non-resident. For every previous year, we have to determine the residential status. Income Tax Act has given the provisions how to determine the residential status of a person. The person may be an individual or a HUF or a firm or a company. From different angles, residential status we have to calculate. For individuals, some basic condition, additional conditions are given. Basic condition says during the previous year, a person should stay for 182 days or more during the previous year. So residential status of individual. Income Tax Act has given the provision regarding how to determine the residential status of an individual. In that case, basic condition, additional condition. The first basic condition says he must stay in India for 182 days or more during the current previous year, or 60 days or more during the current previous year and 365 days or more during the last 4 years. If any one of the condition is satisfied, then he will become a resident. If none of the condition is satisfied, he will become non-resident. So once he is a resident, we have to determine whether he is ordinary resident or not ordinary resident. For that, two additional conditions are given. The first additional condition says, during the last 10 years, at least 2 years, the person should be resident in India. At least 2 years. And 765 days or more during last 7 years preceding the current previous year. Both the conditions must be satisfied. So if a person has satisfied any one of the basic condition and both the additional conditions, he will become ordinary resident and ordinary resident. If a person satisfies one basic condition but none of the additional conditions, or one of the additional conditions, he will become resident but not ordinary resident. These are the rules regarding residential status of an individual. Now we'll come to HUF, Hindu undivided family. Hindu undivided family says if the control and management is completely in India, who will control the management of HUF? The Karta. If the Karta is in India and fully controlled from India or partly from India and partly outside India, then it will be resident. If the control and management of HUF is completely outside India, it is non-resident. Once it is resident, we have to see ordinary resident HUF or not ordinary. In that case, the Karta has to satisfy the additional condition. The additional conditions are same as that of individual. At least 2 years out of 10 previous years preceding the current previous year, he should be resident. And the Karta should stay in India for 765 days or more during the 7 years preceding the current previous year. If both the additional conditions are satisfied, then HUF will be resident and ordinary resident. If none of the additional conditions are satisfied or one of the additional conditions is satisfied, then the HUF will be resident but not ordinary resident. These are the rules regarding HUF. For a firm also same thing. If the control and management of the partnership firm is completely in India or partly in India and partly outside India, resident. If the firm control and management is completely outside India, it is non-resident. So for firm, we have only resident and non-resident. We don't have ordinary resident or not ordinary resident. This ordinary and not ordinary resident will be there only for HUF and individual. That's it. Company. If the company is incorporated in India, whether it is controlled and management in India or outside India, it is a resident. Whereas for companies which are incorporated outside India, if the control and management is completely in India, then only resident company. If the control and management is completely outside India or partly in India and partly outside India, it's a non-resident company. That's all. These are the things you have to write for residential status, and this is very, very important question. Residential status. Write down any 12 exempted incomes under the Income Tax Act. Under Section 10 of the Income Tax Act has given the list of incomes which are completely exempted from tax. Like it is asking you 12. In any textbook you can find the list of all incomes. Few examples I will explain you. Example is amount received by a member of a HUF from the HUF. It is not taxable in the hands of the member or co-partner. Similarly, the next example is gratuity received. Gratuity received by a government employee at the time of retirement, completely exempted. Whereas the other, for example, another is amount received from recognized provident fund or statutory provident fund at the time of retirement, fully exempted from tax. Similarly, some allowances given to MPs, MLAs or High Court and Supreme Court judges, these are examples of exempted incomes. Interest on securities. There are some securities listed under the Income Tax Act. Interest received from those exempted securities, not taxable. Agricultural income, not taxable. So few examples I have given, other examples you can refer. The last one is explain the provisions regarding agricultural income. Income Tax Act has given the provisions regarding how to tax the agricultural income. According to Section 10, subsection 1, agricultural income is exempted from tax. If a person is having only agricultural income, nothing else, complete agricultural income is exempted. Whereas, if a person is having agricultural income and also non-agricultural income, then integration provision will apply. That means both the incomes will be combined and we calculate the tax on the non-agricultural income if a person is having both the incomes. Now the question arises, when the income is called agricultural income, conditions are given. 3 conditions are given. The rent or revenue should be derived from land. The land must be used for agricultural purpose and the land must be situated in India. So if these three conditions are satisfied, then the income is called agricultural income. So when the person is having agriculture and non-agriculture, integration provision will be applied on satisfying the two conditions. The two conditions are the agricultural income should be more than 5,000 and the non-agricultural income should be more than the basic exemption limit. According to old tax regime, the basic exemption limit is 2,50,000. 2,50,000 for non-senior. For senior citizen, 3 lakh. For super senior citizen, 5 lakh. This is the basic exemption limit. So if non-agriculture income is above the basic exemption limit and agriculture income is more than 5,000, then integration provision will apply. Then some steps are given for calculating the tax liability if a person is having agriculture income and non-agriculture. So these are the expected questions from unit number 1 for 12 marks. Now second, unit number 2. This is salary income. Unit number 2 is entirely income from salary. So what are the expected questions for 12 marks on salary income? First, explain in detail the components of salary income. Income Tax Act has given the provision how to calculate the income from salary. First of all, basic. First head is basic. Second head allowances. Third head perquisites. And last fourth head we will get profit in lieu of salary. So basic plus allowances plus perquisites plus profit in lieu of salary will get gross income from salary. From gross income from salary, 3 deductions are available. Standard deduction under section 16(1)(a). Then second, entertainment allowance deduction under section 16(2). Third, professional tax paid under section 16(3). Remember, according to old tax regime, optional tax regime, all the 3 deductions are available. But if the SSC has opted for the default tax scheme, new tax scheme, only 1 deduction is allowed. That is standard deduction. Professional tax and EA deduction not allowed under the new tax regime. This is the procedure. Now under basic, what are the items that may come? Basic salary plus bonus plus fees plus commission plus employer's contribution to RPF in excess of 12% of salary. Similarly, interest credited in RPF if the rate of interest is more than 9.5%. So these are the items that may be taken, that will be taken under basic. Allowances. Different allowances will be taken like dearness allowance, DA, CCA, city compensatory allowance, house rent allowance, entertainment allowance, children education allowance, children hostel allowance, meal allowance, lunch allowance, medical allowance. So many allowances are there. These allowances will be taken under the head allowances. Then third one, perquisites. Perquisites are the benefits which are given by the employer to the employee or their family member, either in cash or in kind. Example of perquisites are rent-free accommodation. Rent-free accommodation given by the employer to the employee. Similarly, concession in the matter of rent. Insurance premium of the employee paid by the employer. Similarly, one more example, motor car provided by the employer to the employee for personal use. Similarly, the services of servants are given by the employer to the employee. These are the examples. Few examples I am saying about perquisites. The next comes profit in lieu of salary. Very rarely, when salary ceases to exist, some amount will be paid, like compensation paid on termination of an employee or amount transferred from RPF to URPF. Then that will be taken under this profit in lieu of salary. The total of these 4 items is called gross income from salary. From gross income from salary, standard deduction under section 16(1)(a). That is list of the following 2 amounts. Gross income from salary or 50,000. Fixed amount is 50,000, whichever is less. Then EA deduction will be allowed if the SSC is a government employee. Then EA deduction will be list of the following 3 amounts. 20% of salary or actual year received or fixed amount of 5,000. Then third one is professional tax under section 16(3). Professional tax paid by the employee. Deducting these three items, we'll get income from salary. That's all. What is provident fund, and explain the types of provident fund. This is very, very important. Provident fund is a social security scheme. That means the employer will encourage the employee to make some savings out of their salary income, so that these savings they can get it at the time of retirement. Because after retirement, the income of the employee will get reduced. They should not face any financial problems. So that's why the government, the law has made compulsory that provident fund scheme has to be applied, and from the salary income amount should be deducted. So what is the scheme of provident fund? From the salary, some amount will be deducted. Example, 10% of salary. 10% of salary will be deducted from salary amount, and that amount will be deposited by the employer to the provident fund scheme. At the same time, employer will also contribute some amount in that provident fund scheme in the name of the employee. Suppose 5,000 rupees are deducted from the salary and deposited. At the same time, 5,000 rupees from employer's side will also be deposited. So 5,000 plus 5,000, 10,000 is deposited per month. And in this way, every month the amount will be deposited in the provident fund, and interest will get credited in the provident fund account. So all this amount, employees contribution, employers contribution, and interest credited thereon, the whole amount, lump sum amount, the employee will get at the time of retirement. That is provident fund scheme. And different types of provident fund schemes are there: statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. SPF, RPF, URPF, PPF. Statutory provident fund will be applied by government organizations, whereas recognized provident fund will be applied in public sector and private sector, and unrecognized provident fund will be applied only in the private sector. And public provident fund is the provident fund which is applied to general public, not necessary to be an employee. Anybody can open the account of PPF in post office or a bank. They can deposit the amount and they will get it after a period of time. These are the different types of provident fund. So what is the taxability for SPF, statutory provident fund? Employee's contribution is the saving, not an income. But the employer's contribution is an income in the hand of the people, in the hand of the employee. But Income Tax Act says exempted. Employer's contribution to SPF, not taxable. Interest credited in SPF, not taxable, fully tax free. Now RPF, recognized provident fund. Employee's contribution is a saving. Employer's contribution up to 12% is not taxable, exempted. If the employer contributes more than 12%, the excess amount is taxable. And interest credited in RPF, if the rate of interest is 9.5%, up to 9.5%, not taxable. Over 9.5% interest credited will be taxable. That is regarding RPF. URPF, actually URPF will be ignored. Ignored in the sense it is not taken into consideration while calculating tax liability, but at the time of receiving the amount, at the time of retirement, the whole amount from URPF is taxable. Then PPF, again public provident fund, the person will contribute. There is no employer-employee relationship. Public will contribute. So in that case, it's a saving. But the amount received at the time of after a period of time, it is not taxed. These are the provisions regarding provident fund. Next is define allowances and explain the types of allowances. Allowance is a fixed monetary benefit given by the employer to the employee for a specific purpose. So apart from salary, some fixed monetary amount will be given by the employer to the employee for a specific purpose, like dearness allowance, high cost of living allowance, city compensatory allowance, then the HRA, house rent allowance, entertainment allowance. For every allowance, the purpose should be given. And allowances will be divided into different categories like fully taxable allowance, partly taxable allowance, and tax-free allowances. Fully taxable allowances are DA, dearness allowance, fully taxable, CCA, fully taxable, lunch allowance, fully taxable, medical allowance, fully taxable, meal allowance, fully taxable, family allowance, fully taxable. These are the examples. Many examples are there. These are the examples of fully taxable. Partly taxable and partly exempted, HRA, house rent allowance, partly taxable, partly exempted. Similarly, entertainment allowance, partly taxable, partly not taxable. Similarly, children education allowance, partly taxable, partly not taxable. Children hostel allowance, partly taxable, partly not taxable. Now, tax-free allowances. The allowances given to MLAs or MPs, the allowance given to Supreme Court or High Court judges, completely exempted. Similarly, the employees who are appointed by government to serve in foreign countries, like ambassadors, the allowances are fully tax-free. So few examples. Other examples you can refer it in the textbook. Next is define perquisites and explain the types of perquisites. Perquisites are the benefits which are given by the employer to the employee either in cash or in kind, either to the benefit of the employee or their family members. So any benefit given by the employer to the employee or their family members either in cash or in kind is called perquisite. Example of perquisite are rent-free accommodation, motor car provided, concession in the matter of rent. Similarly, free medical facilities provided, free education facilities provided, motor car provided. All these are the perquisites. Now, perquisites are divided into different categories like fully taxable perquisite to all employees. Some perquisites are taxable to specified employees and tax-free perquisites. Fully taxable perquisites are rent-free accommodation, taxable fully to all the employees. Concession in the matter of rent, taxable to all employees. Then one more example I can give you, insurance premium of the employee paid by the employer, fully taxable. Similarly, monetary obligation of the employee met by the employer. Example, if the electricity bill of the residence of the employee paid by the employer or gas connection bill of the employee's residence paid by the employer. These are the fully taxable perquisites in the hands of all employees. Now secondly, perquisites taxable only in specified cases. What are specified cases? You can refer it. So in these specified cases are motor car provided by the employer to the employee for personal use, right? Similarly, the servants are appointed by the employer, but the service is given to the employee's residence. That is also taxable for specified cases. And some perquisites are completely exempted from tax. Next comes explain about. In examination, you may get this type of question also. Some 4 points may be given and you have to write for each one. Example, gratuity. Gratuity is a gracious payment made by the employer at the time of retirement. Actually, gracious means voluntary. That is not compulsory. But after passing the Gratuity Act, payment of Gratuity Act, now it has become compulsory for certain types of organizations. So at the time of retirement, the employee will get a lump sum amount in the form of gratuity. Now, Income Tax Act says if the employee is a government employee, gratuity received is fully exempted. For if the employee is a non-government employee, up to 25 lakh rupees gratuity is exempted, the excess will be taxable, right? Then we have pension. Pension is the amount received from the employer after retirement. Before retirement, employee will get salary. After retirement, he will get pension. So pension is a periodical payment received from the former employer. Now, Income Tax Act says salary or pension will be fully taxable under the head salary. Then comes commutation of pension. At the time of retirement, one provision will be given by the employer to the employee that do you want periodical pension or lump sum pension. Lump sum pension means once at a time, the whole lump sum amount will be given at the time of retirement, and afterwards he will not give any pension. That is called lump sum pension or commutation of pension. Income Tax Act has given the provisions. Computation of pension received by government employee, fully exempted. For non-government employees, some limits are given. 1/3 of commuted pension or a fixed ceiling amount will be given. Whichever is least will be exempted, the excess will be taxable. Next comes leave encashment. Suppose if the employee has not availed the leave during the service, at the time of retirement, he can convert his leave period into cash. That is called leave encashment. Again, Income Tax Act says government employee leave encashment at the time of retirement is fully exempted. For non-government employees, some limits are given. Up to that limit is exempted, remaining is taxable. So these are the provisions. Explain in detail deductions under section 16. So 3 deductions are given: standard deduction 16(1)(a), EA deduction 16(2), and professional tax 16(3). Standard deduction under section 16(a) is compulsory deduction. List of the following to gross income from salary or fixed amount of 50,000. And this standard deduction is there for both the old scheme as well as new scheme. Second is entertainment allowance, EA deduction. EA deduction is given is there only for the old scheme. For new scheme, EA deduction has been abolished. So entertainment allowance deduction will be given only to government employees. List of the following 3 amounts: 20% of salary, actual EA received, or fixed amount of 5,000. And profession tax paid by the employee, that will also be allowed as deduction under section 16(3). That's all. So these are the expected questions from unit number 2. Now unit number 3. Unit number 3 is income from house property. Again, you may get one theory, one problem. First of all, you should give the preference to problem. If you are unable to do the problem, you must remember the theory point. First one, explain the following concepts. Net annual value. While computing the income from house property, the procedure says first we calculate gross annual value. This gross annual value is calculated by considering 3 points. That is municipal rental value, fair rental value, standard rental value, actual rental value. By considering these 4 rental values, we calculate GAV, gross annual value. From gross annual value, deduct the municipal taxes paid by the owner. Then we will get net annual value. So net annual value is equal to gross annual value minus municipal taxes. Next comes municipal rental value. The rental value of the property fixed by the municipal authorities. That is called MRV. Then fair rental value. The rent of similar house or similar accommodation in the same locality, in the same area, what other houses are fetching the rent. That is called fair rental value. Standard rental value. If the house is governed by the Rent Control Act, then the rent controller will fix the rental value of the property. That is called standard rental value. Now deductions under section 24. So after calculating NAV, first we take the GAV minus municipal taxes, we'll get NAV. From NAV, deduct 2 deductions are there under section 24. First is 24A, standard deduction under section 24A, which is 30% of NAV. That is compulsory one. For every person who is having income from house property, a 30% of NAV is the standard deduction under section 24A. And 24B is the interest on loan taken to purchase the house, to construct the house, to repair the house, to renovate the house, to reconstruct the house. If loan is taken for these purposes and interest is paid on the loan, it will be allowed. Interest paid will be allowed under section 24B. That is. Now explain the provisions of calculating income from house property and for let out and self-occupied house. The houses are divided into 2 categories: let out house and self-occupied house. Let out house means the house which is given on rent. Rent is collected. In that case, ARV, actual rental value, will be there. In that case, calculate the gross annual value. For that purpose, if the house is governed by Rent Control Act or not, that we have to see. If the house is not governed by Rent Control Act, simply take the higher of municipal rental value, fair rental value, and actual rental value. MRV, FRV, ARV, whichever is higher, that is the gross annual. Minus municipal taxes. we'll get NAV, net annual value, minus deductions under section 24A and 24B, we'll get income from house property. That is regarding let out house. Now regarding the self-occupied house, Income Tax Act says the income from self-occupied house is nil. No deductions are allowed except one deduction, that is interest on loan taken to purchase the house, to construct the house, to repair the house, to renovate the house, or to reconstruct the house. So any interest is paid, that will be allowed as deduction. That means NAV is 0, whereas deduction is given for interest. So 0 minus amount. So ultimately you will get loss from self-occupied house. Loss from self-occupied house. This loss from self-occupied house can be set off against the profit of any other house, right? Then we have, what do you mean by annual value, and explain different factors that are considered to be for determining the annual value of house property. Actually, Income Tax Act says the income received and earned is taxable. But regarding house property, it is not the actual rent received is taxable, but the annual value of that property. What is the capacity of earning of that property? That is to be considered, not the actual rental value. So for calculating, for finding out the capacity, earning capacity of that house, we have to consider different rental values, like municipal rental value, fair rental value, then standard rental value, actual rental value. All these rental values will be considered, and finally we get the annual value. That is gross annual value, right? So we should not be concerned only with actual rental value, but we should consider all the other rental values to find out the correct annual value of the house property. That's it. So these are the expected questions from unit number 3. Unit number 3. So 3 units I have explained. In the next video, inshallah, I will explain the remaining 2 units. What are the theory questions for 12 marks. So always go ahead in subscribing my channel. My subscribers are very few compared to the viewers. Viewers are many, but subscribers are very less. Please come forward. Press the subscribe button and always share my channel among your groups, among your friends, so that more students can watch the video. And inshallah, we'll continue the next 2 units theory in the next video.